Okay, welcome everybody. My name is Matt Brown. I'm the founder and CEO of CAIS. Asset management is undergoing tectonic shifts with a myriad of trends transforming the industry. First, we're in a disruptive economic environment, which includes fee compression, inflation, and of course, higher rates for much longer. Second, we're seeing the rise of alternative investments across every investor segment, especially within wealth management. Additionally, there are many emerging trends and opportunities, including M&A and the consolidation of traditional asset management with alternative asset management. And lastly, there are strong headwinds and also some very strong tailwinds. The most successful firms are not only thinking about how to capitalize on these new opportunities, instead of simply just navigating them. That's why I'm so excited to welcome your panel today, Asset Management Upheaval. I'll start by introducing our esteemed group of panelists. To my, well, not in order, Dan Bienvenue, Interim CIO of CalPERS. Welcome, Dan. Katie Koch, President and CEO of TCW. Tony Manila, co-founder and president of Eldridge. Kamal Bhatia, CEO, president of Principal Asset Management. And Jose Minaya, CEO of Nuveen. Welcome, and thank you all very much for joining us. I'd also like to thank the Milken Institute for giving all of us this opportunity. It's been a pleasure to be able to spend time with such a great institution, and I know today's panel will not disappoint. So we have a lot to cover today. I'll start off with a very broad question for the entire group. What are the most interesting trends you're seeing in the current macro environment that are impacting your business today? Tony, can I start with you?
Sure, yeah. Well, first at Eldridge, we're not focused on where interest rates are going. We recognize that we don't know. We don't know where the stock market's, going either, and so we spend very little time thinking about that. What we do is really try to originate and find investment opportunities, and figure out how we're going to get our money back and participate in the upside. We're clearly, as you mentioned, Matt, in a much higher for longer interest rate environment. Today, I think this is probably the most opportunity that I've ever seen in my career in senior secured lending, with SOFR at 530 and credit spreads in the 350 to 550 range, both in corporate credit and in real estate lending. It's a tremendous opportunity there. Our funding is insurance capital at Eldridge. We own a business called Security Benefit. It's a $60 billion balance sheet. We've built asset management platforms to help us invest that general account. And the funding base at Security Benefit is super sticky. It's 90% of the time when an annuity lapses, it goes into annuitization. Which means we basically pay it out over the policyholder's lifetime.
And Tony, is there a trend that you're seeing that you're keeping a close eye on at Eldridge?
I mean, a trend that we're seeing is just broad opportunity and credit across the spectrum. We're excited about, as I said earlier, I mean, it's the best sustained period that we've had in our careers, really, to put money to work in corporate credit.
Jose, what are your thoughts?
For us right now, it's about what we call the twin peaks, right? You look at where inflation and rates are, and I will tell you, I came into the year pretty optimistic that look, we pretty much have peaked out there. And at the beginning of the year, there might have been 10 or so plus trillion in cash sitting on the sidelines, with this idea of we're going to have a generational move into our markets. Now, interestingly enough, we have not seen that move yet. Right? Obviously, cash is a very investable asset. It impacts my business because we're also big in the wealth channel. I think I heard Pinto recently give a quote around 20 plus trillion now that's sitting in the sidelines. So on one end, there's this incredible opportunity, again, of a generational amount of flows coming into our markets, which I think is going to give us opportunities with our clients. I think it's going to give us opportunities because at Nuveen, we manage around 1.3 trillion, but about 500 billion of that is alternatives. I think that's a new theme, but we're still kind of stuck in neutral, right? We're stuck in, again, folks are kind of holding on to that cash, although you're starting to see it flow by. So again, I'm not that concerned about our investment opportunities. We've got strong performance. I agree with the comments that we said earlier, but our business does depend on flows. And when people have their money in cash, that doesn't really help what we do because we're not short-term or cash investors.
Thanks for that. Katie?
Thank you so much, Matt. It's great to be here. I know we're going head-to-head with Ken Griffin's panel, and there's no one I'd rather do that with than these esteemed gentlemen. So great to be on this panel, and great to be with all of you. Just by way of background, I have the privilege of leading TCW, as was mentioned, and for people's knowledge, we're a global asset manager established 50 years ago. A lot's changed over the last 50 years and evolved in the world. Consistent with us is that we have high levels of employee ownership, that we're investment-led, and that we continue to have very long and distinguished track records in disciplined credit selection. And so you asked about some things, macro things happening in the industry. I'll name three very briefly around credit. First, in public markets, I'll just say something because some people are interested in near-term market content. We would be a little bit non-consensus in our credit positioning. We see a lot of opportunity in fixed income, and we'll unpack that more. But we are currently where we do express a macro view in our portfolios, which is not everywhere. Actually, in most of our strategies, we don't. But in core plus fixed income, where we do express a macro view, we're overweight agency MBS, and we're actually underweight credit markets. We think the current backdrop is not in line with credit spreads being the tightest that they've been since the global financial crisis. So that comment specific to public credit markets, and we were more conservatively positioned there, carrying over the index with agency MBS, being paid to be patient, and then our team has a very long and distinguished history of leaning into those credit events when they eventually happen. And then two broader comments from an industry perspective, because you asked about trends that we're focused on or things that may develop. I do want to give a shout out to Tony and to Eldridge on this first trend, which is they were very early in identifying how insurance companies and those liabilities could be connected to asset managers. One of the first people to do that, and we think that's a trend that's going to continue with more asset managers finding more permanent pools of capital. And then the second trend, I would say, would be in private credit markets and the continued evolution of those markets and partnerships between very distinguished private credit managers and also banks. And we announced one of our own this morning, and that's a trend that we think will continue.
Katie, that's great. You did mention the power of the insurance platform. There's been a lot of talk about that lately. You're seeing many big asset management firms make acquisitions. Eldridge, I want to come back to you before I go to you, Dan. Tony, could you just give us a little more depth on that and the advantage that can bring an asset management firm, and how does Eldridge capitalize on that?
So KKR and Apollo are two fantastic organizations out there. They started with the asset management businesses and have acquired insurance platforms. Since late November, KKR's market cap is up $25 billion. It's up almost 40%. The reason it's up, I think, is because they acquired the 40% of Global Atlantic that they did not own. And so I think the market is really coming to appreciate that fee-related earnings from a captive insurance platform are just as valuable as the fee-related earnings from third parties, and give asset managers a fantastic amount of flexibility to really develop and grow products and serve their clients.
And you see that trend continuing?
I think so, yeah. Yeah.
I'm going to skip over you, Dan, just for 1 second for a reason. Kamal, just back to kind of macro trends that are impacting you. Can you walk us through some of the things that you're thinking about kind of on a day-to-day basis in that category?
Sure. So Matt, glad to be here. It's good to be with Tony, Jose, Katie, and Dan here. So I'll go back to your question on macro or trends. So as an asset management CEO, I think one has to be a student of history and read a lot about the future. So from my seat, if you think about the biggest change that's happening in our industry is you could go back 25 years because history can give you a sense of how the business has evolved. When the dot-com bubble burst, I think we entered an era where sort of value investing died and growth invested starting. The internet transformed it. We suddenly discovered that tech companies were really the companies to invest in. And you went through that period, which I would call that really growth investing came into vogue and sort of credit investing came into vogue. You kind of hit the GFC, and I would say that was a seminal point that saw the love affair with public markets shift towards private markets. We have had a 15-year period where we had tremendous interest in private markets. I think as I sit here today, I think we are at the dawn of an era of where the 360 investor is going to be the future. An investor who understands the interplay between public and private, an investor who understands the play between equity and debt, because that, I believe, is the macro future and a little bit of the future of where asset management is going. And it's not just a US phenomena. We operate with clients in over 80 countries, and I have a lot of these conversations. It's happening in Asia, it's happening in Latin America, and it's happening in Europe.
And just maybe a second on your firm, just in terms of the scope and scale, it's quite impressive what your business has done.
So I'll give you an example of our business. So obviously, we have close to 750 billion in AUM and 1.6 trillion in broadly our retirement businesses as well. I think the biggest transformation we've seen is when you think about this idea of quality. One of the observations I have is particularly in private markets, quality has deteriorated, while in public markets, quality has come back into vogue. So as an investor, one of the things we constantly think about is when we serve institutions, when we serve wealthy individuals, or even when we serve retirement plans, what's the best place to invest their capital? And if I apply this idea of quality, irrespective of how an asset class is tagged, that's how we invest. And I think that's a perspective. You were just asking Tony about insurance companies. What's better than owning an insurance company is to be an insurance company for 145 years. Right. So you learn a lot during all those market cycles. But even through our permanent capital, like the insurance company, this idea of not getting attached to asset classes, but really looking at relative value with, as I said, a 360 perspective is what we're really focused on.
Thanks, Kamal. Dan, I saved you for last because you're a bit unique because you are an asset owner as the CIO of CalPERS. So, maybe a second on that. You're also the interim CIO, I noticed. Tell us just a bit about your role and then the macro trends that you, from your seat, are taking a look at, keeping a close eye on.
Yeah, happy to, Matt. Thank you, and thanks for having me. And it's a thank you to the panelists and the Milken Institute for letting me be up here with this amazing group of people. So I'm the interim CIO. We've just hired a permanent CIO, Stephen Gilmore. He'll be joining us from New Zealand in July, which I'm very much looking forward to because it's been busy lately. My permanent role is the deputy CIO of capital markets, so I'm on the public market side, and then I also run all the operations for the organization on the investment team. In terms of macro, I mean, it's an interesting question, and hearing like the asset management perspective. We, in the capital market side, we have people that are in the markets daily, and so for them, they're keeping a real-time view on macro things to try to drive alpha in the public markets portfolios across equity and fixed income. For me, my focus is much more strategic and much more long-term, myself and the senior team. And so what we're looking at is really, what is going on in the world over 5 years, 10 years, 20 years, because that, our liabilities are measured in generations, so we're really focused on very long-term outcomes. And there, I would say the first thing that we're looking at, obviously, is inflation and how inflation plays out. For us, inflation is really important because it has both an asset impact on the asset side of the balance sheet, but then also on the liability side of the balance sheet, because most of our liabilities have inflation components of various sorts. So super focused on inflation, and while, like Tony, completely agree that we can't predict interest rates, But then what does that do for interest rates? Not because we're trying to time them, but more because finally we're at a place where interest rates, and and Jose talked about this, where interest rates are actually accretive. I mean, there was a decade-long period where for us, owning duration was really just about a hedge for a significant amount of equity risk, and now we can actually earn returns. I mean, our discount rate is 6.8, but I would say our target is, call it 7. We can, you can earn a significant portion towards that now with fixed income instruments. So, again, focused on inflation and then how that impacts interest rates and how we can use all of that to come together in the portfolio construction sense, and then where does the economy shake out and what does that do for earnings, of course, both for supporting credit, but then also supporting equity and equity valuations.
Are there things that you're doing different today than you've been doing in the past years because of the current environment?
Yeah, I mean, like I said, I would say that we are probably, we just recently we've done a couple of asset allocation studies recently, and I'm sure we'll talk more about this later, but we're definitely leaning into private assets. We had a history where we were early to private assets, but then we were probably, underinvested in private assets for a significant period of time. We're really focused on, I say this as the guy who's responsible for public markets. I joke that I'm a recovering public markets investor. Really focused on investing in private assets. And then other couple of things, we added leverage strategically to the portfolio. So our net asset value of the portfolio is actually 105% of assets, or gross asset value, I guess I should say. Net is 100%, but we have 5% of strategic leverage in the portfolio. And then, as I say, the last thing is actually looking at income producing assets as not only being hedges, but actually accretive to the return prospects.
Got it. Thanks, Dan. Let's now switch, and I think now we can all see the opportunity we have with this panel up here being the leaders in their industry. I want to switch focus to the rise of alternative investing. Preqin states that the global alts market will add more than $8 trillion in AUM over the next 5 years. Many actually think that's not high enough in terms of where it really will be going. And that will include, of course, private credit, private equity, et cetera. Katie, in your view, what are the biggest drivers behind this growth? How are you thinking about it, through your lens? And also, at some point, I do want to talk to you about today's announcement on PNC, but I can put a pin in that if you want to and come back to it later.
I'm happy to address that because it's a little bit related to the growth of the asset class, so I'll start there. So we are very optimistic about the future growth trajectory of this asset class. At TCW, we need to be in private credit, regular way direct lending, which we've been doing for 23 years, and asset-backed finance, which we've been doing for 25 years, and we're going to evolve those capabilities. We aspire to be relevant to the borrower, public-private across the capital structure. That allows us to deliver for our main stakeholder, which is our client. So that's really driving our interest in that asset class. And we've doubled effectively the size of our alternative credit platform over the last couple of years, and we expect to do more of that. I'll say something quickly on our partnership, something brief about the history, and then where I think this will end up. On the partnership, we're really proud to have entered this morning. We announced in a partnership with PNC, which of course is one of the leading US banks, ranked number 4 in middle market lending, great balance sheet, outstanding management team. And this partnership we think will be different from others that have been announced for 3 key reasons. The first is that it will be very focused on middle market, where we both have deep heritages. The second is that we actually have a strong working partnership with each other. So in its simplest form, when people say, why are these partnerships happening? You might say, oh, it's because banks are long origination capability and short lending capability because of regulations, which we can talk a little bit about. And asset managers are shorter on origination capability and longer on lending capability because investors like Dan want to come to the asset class. That's true, but it's not enough to make a successful partnership. In our case, we've worked together for 15 years. And we've done, about 30 transactions together. And then finally, we're actually putting people from both groups, because of our shared history, both PNC and TCW, onto this investment partnership, which will be led by my phenomenally talented colleague, Rick Miller, who's the CIO of private credit. And we do think that this will help us extend our private credit capabilities. I want to say something now, just brief, about why has this asset class grown so much, and then end with where we think it's headed. So if you break it down, I'm also, by the way, Dan, I think you know this, but I'm a recovering public markets investor too. So it's very exciting. We're in recovery together. But I have the view, having invested in public equity markets, which have been massively disintermediated by private markets over the last 20 years. There's half the number of public companies, as Dan lived through too, in public equity markets than there were 20 years ago. That number should be a lot higher because the economy's grown a lot. It's not, it's half. We're in the early stages of that playing out in private credit, hence our real, very keen focus on this at TCW. Why is that happening from a supply perspective? This asset class was not born because of bank regulation. As I mentioned, we've done it through 3 recessions and for 23 years, but bank regulation has expedited the growth of the private credit asset class. Banks have had to retreat from lending, and Wall Street's very good at coming up with supply to meet demand. We need credit to grow. It can come from banks or the investment community, less coming from banks, more from the investment community. And then from a demand perspective, I don't want to speak for Dan in particular, but insurance companies, other asset owners, they're willing to sacrifice some liquidity for additional return, which they need in their portfolio. And it also happens to, we can argue the merits of this, but it does smooth volatility. And that's a good outcome for a lot of institutional investors. So the demand's been there. We think those dynamics will continue. In the future, the only thing I want to really mention about this asset class is that manager selection may matter for the first time in the history of the asset class. So people in Dan's seat have done private credit investing and selected managers, but the truth is the dispersion between a top and bottom quartile private credit manager is 15 basis points over the last 15 years. So it hasn't mattered a lot because money's free and we all get to be geniuses when rates are 0. You can ask us. And then, but going forward, we think that differentiation is actually going to be much greater. And so we do think it's really important to focus on 2 things, and I'll end with this, when you're looking for an alternative credit or a private credit manager. And they're impossible to replicate. They are massive differentiators. The first is time. And 95% of these managers launched post-global financial crisis. So you want to scrutinize that. People who have invested when rates were not 0, people who have invested in different macro environments and through recessions and have had to been at the table to work out of these issues. Time is a very important differentiator. And also discipline, which is, does the manager always invest with the same level of discipline, or is the market environment determining their discipline? You want someone that's diligent heavy, covenant heavy, and you also want someone who does have the workout experience that I referred to earlier, and that is able to continue to repeat that discipline in the market. And that's, if you do that, you can have a track record like the one Rick Miller and his team produced at TCW, where they've made 300 investments over 23 years and they've had 4 losses. And the reason that you're able to do that is that combination of experience and discipline.
Katie, I think that's really, really interesting. And I just want to just state a bit more on alts for a second. And Jose, Nuveen has obviously built a global brand, and you're also now really, I think, doubling down more not only on alternative investments, but also really thinking about financial advisors, their portfolios, and increasing within wealth. Can you talk about some of the motivations that you have and why you think that trend is going to continue?
Yeah, look, and I think alts has been our fastest growing segment. Even if you just look at private credit, we started at basically 0 in 2014, 2015. We're at 72 billion today. You could translate that into what we do on the infrastructure side, what we do on real estate. And I think you're going to see more and more deals like the one Katie just described. But what's interesting is Preqin, others have been forecasting the growth around alternatives for some time. So what's changed? I always say you've had basically what has been an academic exercise. So probably I spent a decade going around talking to clients saying, I know you haven't seen inflation, but it may show up. Are you prepared for it? Yeah. Hey, by the way, yield is pretty important over here. Hey, you may be putting more punitive kind of allocations around illiquidity than you should in your portfolio. Those things today are an urgency now, right? We think about the democratization around alternatives. That's already happening. We, for example, and I think you heard Apollo talk about this earlier today, you've got firms like Apollo and Blackstone talking about themselves as retirement companies. You look at the 401k space, there's almost $13, $15 trillion kind of pool of capital there. And the folks who are least exposed to getting access to these types of securities are the...
But why is that, though? It makes so much sense. Longer lockup capital, less liquid investments. What's holding the 401k community back from allocating?
Well, first of all, what was holding it back is that you could easily, in the last almost 20 years, you could just invest in a really 3, 4, 5 BIP kind of target date fund that was indexly managed, 70, 30, 60, 40, call it what you want. And that was fine when markets are doing this. I think when you have a realization where all correlations can go to 1, that is a big issue. And now what you've had is, which I think is one of the only pieces of legislation that easily were passed on both the left and the right side of the aisles, which is the Secure Income Act. So what is the Secure Income Act? The Secure Income Act is now being allowed to put in a retirement account, in a 401k account, a guaranteed income, call it an annuity. Why is that important? Guess what feeds annuities today? Right? We're owned by an insurance company. How were we able to grow this quickly? What feeds annuities, because they could take illiquidity, they could understand the sophistication of the correlation benefits that these asset classes bring. The loss profile, as Katie said, our team, we might have acquired them in 2015, but they've been around for almost 28 years. In the global financial crisis, the worst credit crisis in history, their net return was 4%. Again, these things offer you structural benefits. There's not been an access to it to the overall retirement community. What you're seeing now in the form of target date funds, putting in these sleeves, I think you're really truly seeing an acceleration around the democratization of this, because it is just a necessity to the retirement crisis.
When we all talk about democratization, it's always a positive. More access, a three-dimensional portfolio that can finally, include alternative investments. Do you also think about the flip side of that? What could go wrong if responsible democratization, or how we introduce financial advisors and high net worth individuals to alternative investments? Is there a
there's always another side, right? And I've in my career, I've kind of focused on the private side, and I've always said, hey, there's moments we'll go into a cycle with something. I always say, where do you get alpha in these securities? My team doesn't like it when I say this, but largely investment performance is somewhat commoditized today. You talk about how you're separated by BIPs. At the end of the day, where you get alpha is the access to these deals at the end of the day. And as you get more access, you look at real estate, for example. Today, you can invest in a publicly listed REIT. Are you getting the right correlation? Well, no, that you can have bubbles in there because there's a lot of access to capital. But where you are today, it's not Dan and the counselors of the world, or the CalPERS or others who have already been invested in alternatives and are leaning in a little bit more. I think the big push here is how do you open it up to the broader market? And you're right. As you do that more, you start losing your correlation kind of characteristics and benefits. But you're at the way end, front end of the spectrum. This was no different from private equity funds. Today you launch a $40, $50 billion private equity fund. I think you may have a really good manager behind it, but I'd argue it's still going to be pretty highly correlated at that size.
Kamal, do you see a time where we're kind of looking back and thinking, God, I can't believe we had a two-dimensional portfolio, 60-40? Are we 3 years away, 10 years away from just the standard of every end client portfolio being, fixed income equities and alternative investments?
It's a great question, Matt. So I'll go back to, I think if you go back to the genesis of 60-40 portfolios, obviously it came a little bit from when capital efficiency was all in the vogue, and this whole idea of getting balance in your portfolios. So I don't think the idea of balance in a portfolio ever goes away. That's the essence of investing. I think if you break it down, it's really the purpose of those portfolio constructs was you wanted a part of your portfolio to do enormous amount of compounding, which is what investors focus on, and then you wanted a part of your portfolio which was generally viewed as safety, but I would argue, it's paying the bills, and for a pension plan, it may look different than somebody who's a retiree. My view is if you look at it in the context of retirement, and here's how I think about it. Retirement is the next frontier for asset management. There are really 3 places where investing in the world happens. It's either savings, which was domain of banks, which eventually, as post-GFC, the banks transformed, and Katie talked about one of our partnerships. I think banks really evolved over a period of time, and the business of savings moved away from banks to wealth managers. And Matt, you know that place well, and all of us participate in that in some shape or form, and that concept of 60-40 plays out there. We actively participate there. Then the next wave was this idea of protection, which was really insurance companies. They were providing protection, and asset managers realized, well, that is a place we could participate in. I think the next frontier, which is the third wave, is bigger than the last two. The insurance waves were bigger than the savings wave. Retirement is the biggest wave ahead of asset management, and we do this business in many countries in the world. And my view is this idea of balance that you're bringing in is probably more valuable in retirement than it was even valuable in savings. Insurance companies are really liability investors. I think that concept is coming to retirement now, where you have to pay attention to how you manage your liabilities, in essence, to your assets. As we do work around this idea of like, what does the future of a balanced investor look like in retirement, I think probably the more tougher problem to solve is not about investing. It's what I would call three key things that are totally ignored. One is education. I think there's a lot of control in the end investor in the retirement business, which you don't have in the insurance business or the saving business. So you have to be really astute, committed to education. You really don't get to be in the business of asset management if you're not good in the business of education. And we indirectly do that working with employers. The second piece I would highlight for you is trust. When your end investor is not purely an economic investor, they are investing on the basis of trust. That is a very different way to invest. You obviously can generate returns, but they have to believe in you more than the financial results. And so I would say that changes the nature of balance of what you brought up in 60/40. So I think this idea of what balance really means moving forward is fundamentally changing, and you have to process that in the context of investing.
And some of the firms that we've mentioned here by name have been very thoughtful around how to structure products that are more accessible. And I think at some point we want to get to that.
Yeah.
I just want to circle back with Dan and Tony here, both from a credit standpoint, private credit standpoint. Dan, you announced that you're increasing allocations in this category recently. Tony, Eldridge's core is credit investing. But at the same time, we're hearing a lot of chatter around, is there just too much in this space? Is it growing too fast? What are the risks? I don't know, Dan, maybe you could kick off with just a brief conversation around, maybe the flip side of the opportunity of private credit, and share a bit what you're worried about. And Tony, I'd love to hear your thoughts on that as well.
Yeah, happy to. I mean, you make a really good point, Matt, that, there's a lot of dollars coming into private credit specifically. Now, I think Katie also made a really good point that with the bank stepping back, I do think that you've got lots of opportunity there. And, we're looking, of course, at, sort of standard direct lending, but then also diversifying that into like asset-based finance. And even we think that there's some commercial real estate lending opportunity starting to emerge out there. But for us, frankly, and again, it goes back to what Katie said, it's about underwriting. And I feel really blessed that we have a woman named Jean Sue who runs our private credit allocation. And early on when Jean and I started working, it was right after the financial crisis, we started working together on some stuff, and Jean was underwriting fixed income assets, and as I say, I was on the public market side, and we were putting public equity beta over the top. I very quickly learned to realize that if Jean was comfortable with an investment, I was eminently comfortable with the investment because my risk appetite is just significantly higher than Jean's. But it really is critical to be focused on underwriting standards, who the managers are you working with, what are the assets that they're working on, what are their ability to do workouts and all of those things, and having invested through cycles. And so,
Do you think the opportunity is still alive and well?
I do. If done right. I also think that,
For sure.
that the dispersion of 15 basis points, it could easily be 10x that, if not more, on a go-forward basis. And I think you got to get it right.
Tony, I think there was an article in the Journal a few weeks ago about banks now partnering with private credit shops. I don't know if you saw that, but what's your view on that? What's that signaling to us? What does that mean for the banks, and what does that mean for the private funds that are in private credit?
Yeah, that's what Katie announced this morning with PNC. It's a great organization, and we've done some work with them recently as well. I don't. What is private credit? right? The entire broadly syndicated loan market is a form of private credit. You have investment banks that originate to distribute into the CLO market or the ETF market or the mutual fund market, and they really have no skin in the game. They make a fee. And it's up to the manager to play defense and protect the investor's portfolio. Private credit really is just disintermediation of those banks and an allocation of capital directly from, it's a principal to principal transaction is really what people mean by private credit. And I think that's healthy for the market when you have a principal that's directly negotiating with the private equity sponsor or a company to be able to, deploy capital as opposed to, JP Morgan, not to pick on them, but, making a fee and distributing. And I think, historically banks competed on covenants, they competed on spread, they competed on then structure. And they'll use the law firm that, Apex wants them to use or KKR wants them to use so that they have a covenant package that's extremely borrower friendly. And private credit, the emergence of private credit, and it takes a lot of different forms. We do private credit at Eldridge in the form of what I would call senior secured plus plus, which is a strategy that we have at Stonebriar, which is large ticket equipment leasing that has originated $15-16 billion since inception in 2014 and had 1.5% annual defaults and 105 cent in the dollar recovery. This is because they are encumbering absolutely essential use equipment that, absent a liquidation, the company is going to reorganize, is going to affirm those leases, and is going to continue to thrive. So I think there's a lot of chit chat on private credit, but I think it's a very healthy development for the market, and you're seeing now Blue Owl is accessing a CLO market and with securitization technology.
Anyone have a different view on that? Or are we all pretty consistent?
No, but I did want to add something just to the retail. Could I say something quickly on that, on individual investors?
Let's do it.
Okay. You asked about the other side of the coin on that, and I just wanted to mention that's something that we're thinking about a lot as a team, because I mentioned we have a very long track record in private credit, but we haven't yet brought it to the wealth market. And so we're really trying to think about the right way to do that. And the one risk I just wanted to highlight around that is, first of all, there's this concept of fixed income replacement. And we understand that, and we understand the need to own these private assets and portfolios because that's where GDP is going. But liquidity also turns out to be really important. And so I think you can replace some of it, but not the whole liquid market, because people still have spending needs, they have pension obligations they have to pay, et cetera, et cetera. So I don't think we want to exaggerate how much of a portfolio can go from liquid to non-liquid. And I also worry with individual investors, in my experience, and we have a team that's worked in wealth for a very long time, they sometimes want that liquidity when it's very difficult to get for them and when getting it would work adversely to them. And that is a problem on the redemption side. And then on the subscription side, if you're taking in a lot of money all the time, you're actually being forced to lend money. We're in the business of saying no most of the time. So we like to not be forced to lend money. But in these products, if you have to deploy capital at that quantum, you need to be able to navigate that.
Absolutely.
So those are two things I think we have to really protect and be thoughtful about when we're building this product and bringing it to wealth.
Well, so many great asset management firms are really kind of thinking through the best way to balance a product structure that is usable and accessible for a financial advisor, scalable across all their clients, oftentimes evergreen structures. But you're absolutely right, it does come with open-ended investment periods where you're bringing in more capital in advance of being able to put it to work. I want to switch to a fairly non-controversial topic, which is ESG. There just seems to be an evolution happening here, or revolution happening here. The approach that's been taken the past decade plus is somewhat being looked at and rethought. I don't know, Kamal, maybe you can kick off this conversation, or you can leave the stage if you feel. But I do think it's an important one that we hit, and I think we can all probably agree that ESG is not going to necessarily look the same way in the next decade that it did the past decade.
Yeah. So, as you said, it's a topic where nobody has any view. I think probably the most misunderstood thing about ESG is everybody has an opinion, but we haven't found a single way to describe it. You know, I have investment staff in over 25 countries, and we work with a lot of regulators. And one of the biggest challenges in the topic is there's not even a common set of regulation around this thing. We all work in a regulated industry. At least the business of asset management is largely regulated all across the world, including United States. And the fact that if we can't even come up with a common definition from a regulatory perspective of what this really means, forget about implementing it. And so my problem is a little bit more fundamental on this topic. At the end of the day, as human beings, as investors, we always want to do the right thing. We don't want to, do investing that hurts society or the environment. But the fact is this whole topic needs a little bit of a step back to say, what regulatory framework can we provide? And I have a fundamental belief that investors will work with that framework. But the lack of framework, in my mind, is the biggest issue today.
But I also tell you, because my firm, we've been kind of ESG leaders for 5 decades, right? We manage around 50 billion in ESG labeled products. I'll tell you, that's not the interesting part, because that's just a product. Right. What's more interesting is the narrative that we're getting in just about every RFP we do. And I'll tell you, the last 10 years, I'd always get asked this question, this ESG thing, is it real? Are people really buying this? And I would always say, you're going to know when it's real, when the regulators show up and when the politicians wake up. Because they always do when money's really in motion. When it's not, and it's just people's websites and all that, everyone's kind of cool and happy. But when the money actually starts moving, that's when you're going to know you're going to have to put a framework in place. By the way, that framework is very disruptive. Like, you look at SFDR rules in Europe, they're going to be disruptive. We've kind of scrambled at times. Do we have to change our perspective? What do we do? But that transparency is what's important, because no matter what happens in this space, 2 things are not going to change. The risks that are carried by things like climate change, right? Like, we've seen floods in these places, you've seen hurricanes. Like, this stuff impacts your portfolio companies. And the managers who are better at managing those risks are going to get better returns. You're going to be judged not by how the philosophy of ESG, you're going to be judged by your returns. And the second piece is your clients care about this. Every RFP I get, I don't know about others here, but every RFP we get, we're getting questions around this. So you have to be good at it, which is why you saw it in just about everyone's website. So what's happening differently now? I will tell you, whether you're seeing a shift or not, I couldn't name you many asset managers that are doing anything different other than how they talk about it. But what they were doing before versus what they're doing today, I assure you.
How are they talking about it differently, though?
All of a sudden, like, it's not mentioned, or it's a little bit quieter.
Or they're not talking about it.
They're not talking about it, or they're talking about it like responsible investing. But what they're actually doing underneath in managing their business, the investment process, that's not really changing at all.
Does it need to change?
I think what needs to change goes back to Kamal's point, which you're seeing already come in, is you need more transparency. You saw the SEC give fines for people that kind of slapped ESG on a fund and got challenged on it. You've seen other kind of compliance rules come in. That has to happen to have kind of natural flow of capital in this one. So it does need to change, but it's the transparency for years. I mean, I challenge anyone here, go to any website. Are you really going to find any company that doesn't have something about this on their website in some way? Do you think it's because all of a sudden the C-suites across America were like, my God, we really care about the rainforest? No, they are reacting to their stakeholders. They're reacting to their employees, their clients, their shareholders. That is not going to go away, but there is a fear.
What has been the real adoption of ESG? Let's just kind of...
What's that?
What has been the real adoption of ESG? Are you seeing flows? Are you seeing meaningful flows?
We saw meaningful flows going into ESG funds. We launched our own set of ESG ETFs, and we saw meaningful flows because, again, when I say the ESG product side is not that interesting, that's what we all do, meaning, there's an interest in something, our clients are asking, we'll create a product that is regulated, and we'll put it out there and come in. But I think the meaningful adoption is where the RFPs that come in, private credit is a good example, where our teams maybe never had to think about ESG if you were a middle market lender. All of a sudden, they're coming to us saying, what do I do? I just got 20 questions on this.
Yep.
So the adoption has been more that clients are pushing on you. And the next adoption is, what's happening is you're losing business because of it. Because if we do a better job of answering that RFP relative to the next manager, we're going to get a better job of winning it.
I'm going to come to you in 1 second. I know you have a strong view on this as well, Dan, but from your perspective, from CalPERS, obviously being a pension fund, let us, get a window in on how you guys think about ESG and the evolution of it.
Yeah, I was hoping to be able to duck this one since it's so non-controversial. So non-controversial, but I guess I'm going to have to answer the question.
My plan was to start with you first. Don't consider yourself getting off easy.
Yeah, I think, unfortunately, ESG has been greatly politicized. And I do think that's very unfortunate. In fact, we tend not to even use the term ESG anymore. We tend to focus on a sustainable investment. But I do think if you go back to it's hard to argue that climate change isn't happening, that there's going to be an energy transition, that all these things aren't real. And those things are going to come with regulatory impacts. They're going to come with subsidies and the CHIPS Act and the IRA and the like. That is something that is happening, and that will have investment implications. You cannot find someone that can tell me that if you have a decision-making body of 100 Dan Bienvenus, you're going to get a better decision than if you have 100 diverse different people that think about the world in a different way, whether that's a portfolio decision, a business decision. So I don't know how you can argue for non-diversity is better. And then G, who's not going to be supportive of good governance? Clearly, I have seen the challenges that come with bad governance and good governance, and governance is a critical way that drives portfolio company outcomes. But for us, as I say, we use the term sustainable investment. We just recently launched a Sustainable Investment 2030 strategy. And it's all about leaning into these themes that we think are about driving investment outcomes. And again, what
are some of those themes?
Certainly climate change. So one of the things that we have is we have committed to doing $100 billion in climate solutions. We have about $45 billion now. And by climate solutions, that can be through the lens of adaptation, mitigation, all of the way we work through the energy transition and the like. Another one of the themes is about, as sort of diversity and focused on diverse and emerging managers, these managers that are the sort of next generation of investment talent. But again, to us, I do think it's got to be about the sustainable investment outcome. I alluded earlier, our liabilities are measured in generations, right? We're investing for the people that are retired now, the people like me that are in the middle part of their career, and the people that are just coming into the CalPERS benefit stream. We need to be able to invest for all of those, and how assets, whether that's portfolio companies or infrastructure assets or real estate assets or the like, how those will be able to sustain their cash flows over those generations to pay our benefits, that's critical. And ESG will have an impact on that.
Katie, can you add a bit to that?
I agree with the concept that companies that don't destroy their environment, abuse their people, or have bad governance will do better. So that's a good...
Thank you.
We focus on all those things and investing across the capital structure. I do also agree, unfortunately, it's been politicized, and I just want to end with the fact that you asked if there's going to be demand. I think there's going to continue to be demand, and I'm hoping that people will start to view it through a less political lens, and we're really focused on it from a value creation perspective. And so on climate, we run an equity fund called, the ticker's NetZ, and it doesn't matter if you're a big climate person. It's popular in red states and blue states. It's a purple fund. And you can really invest in the companies that are driving the transition. That's going to happen regardless of what your political views are. As a country, we've already decided to spend trillions of dollars in that transition. And this is a vehicle that, regardless of your political identity, you can invest in and create wealth over time, because that's the direction the country's going in. That, and then the only other thing I wanted to mention on the governance, the only passive thing that we do at all at TCW is we do run an ETF that tracks the S&P called Vote, which actually votes actively instead of deferring to the proxy advisors, takes an active view on how to create shareholder value. And so I think governance is an opportunity to really push and unlock shareholder value. The standard indexes support 15% of shareholder proposals, and this vehicle supports about 80+%. So I think governance, to your point, Dan, is a very big opportunity to drive more value.
I think that's right. Tony, if you don't, do you have something to add on, or I wanted to ask you, switch to a different topic with you?
You don't want me to talk about ESG?
I've seen you talk about ESG. I'm just a little worried about it, actually. All right, give it to us.
No. Go ahead.
Okay, so,
It's just much better to be having this conversation in 2024 than it is in 2021.
Yeah.
Everyone's thoughts on the topic.
So, Tony, McKinsey reports that the gap between the top performing asset managers in terms of success, revenue, and growth, and the bottom percentile is really growing. And that's leaving kind of a have and have not environment in the community. What are you seeing for the industry of asset managers who are, in that bottom quartile? How do they compete? Are they going to be around in 5 to 10 years? Is it going to accelerate M&A? Like, what are some of your views on that?
I think the industry is in store for a lot of consolidation. I think we're starting to see it right now, and it'll continue to happen. At Eldridge, we own 5 investment management platforms, and we've built them largely from scratch. And being long liquidity by generating annuities and collecting that cash, we need to find ways to put it to work. And by controlling origination, is a way that we're able to add security benefit to have an industry leading earned rate that's over 8% right now. And that's because we've largely been focused on originating floating rate assets, which are senior secured credit for the most part. We're also good, big limited partners in certain circumstances. We're a limited partner of Rick Miller's and Katie's at TCW. We have, I think, Katie, a 10-to-1 co-invest ratio.
Yes.
Yes.
Yeah.
So that
a lot more we can do together for sure, though.
We're very proud of our ability to be a fantastic co-investor. We know what it's like to lead transactions. We can put capital, to work. By leading a transaction, we're also happy to be, a co-investor and give someone else the keys and allow them to, negotiate a transaction and be a good, supportive partner. Yeah.
And being a bit familiar with your portfolio, you own some very unique assets across many different industries, but always keeping kind of that core credit discipline. The ESG question, by the way, was just a softball warm-up from this question I'm about to ask. So we have a very important election coming up. And in all seriousness, I think we need to know and want to know how you're thinking about preparing your firm and what impact this election may have on your business. I don't know, Jose, maybe you could kick off.
Sure. I always say, I get asked the question a lot, as like a lot of us do around, hey, what keeps you up at night? And I always say that we blink. And what I mean by that is, I've had the benefit of experience through Brexit, the first Trump election. A lot of these things kind of happen and you think the world's going to change. And you write the memos, we're going to put hedges, we're going to do this stuff. And ultimately, last minute, we pause and we say, it's about the fundamentals and what we do. So for me, from the election perspective, other than it's interesting personally, how we're kind of managing our portfolio, I always kind of gear in on we should only focus on the things that we can control. I can't control the election. I don't think it's going to have a big impact, honestly, in our market one way or the other, at least in the medium term. So you prepare for volatility, which you kind of have to be prepared for volatility today. And when you think about how we pick securities, how we invest in people, I can't imagine any of that changes regardless of who's president in November.
Do you think, Jose, there'll be an impact overall on the industry of asset management, depending on which direction the election will go?
I don't think so, because again, I went back to the biggest issue. One of the things this country has is a retirement crisis on its hands. And actually, you've seen like I said, the Secure Income Act is one of the only pieces of legislation that really passed very easily, right? So this is something, regardless, blue state, red state, Democrat, Republican, left, right, people are going to care about solving this issue. There might be issues with the IRA. So again, there might be sub-asset classes and things that we look at and go, okay, are you going to have more regulation or less regulation? But honestly, is that really that different than how we've thought about this in kind of various elections and cycles? No, not really.
Kamal, you're nodding your head in potential agreement. Do you think the election, regardless of which way it turns out, will have an impact on how you think about managing your business or on the industry overall?
Yeah, I don't know if the election, it's always tough to predict, but I think the one thing that will impact our business, but also America overall, is public policy. And I'll pick two topics. Jose touched upon one. We as a nation, like so many nations, is at a cusp where fewer people are going to be working than people who have worked before. That is a different state in our history as a nation we've ever been at. And public policy towards retirement, which is effectively about paying attention how you manage society overall, is not a debate we actively have in society in America. But I think other countries like Japan have lived through it, and China is going through it. So I do think that our discourse on public policy on retirement is going to have a big impact on how we operate as a nation. I think the other thing, which I fundamentally, a personal thing I believe in, I grew up in a country which is the biggest democracy in the world. If you measure by the number of people, it has an active election going on. But if you take the discourse of that election, the one thing they are very focused on is education. And I think the quality of education in America has always been great, but I think it has to keep up with what AI is bringing to us as a society. And I think we have to process that public policy debate. So retirement and education is probably going to influence my opinion about what happens in America and what happens in asset management more than the election itself.
Katie, how do you factor in outcomes of the election into how you think about leading a business?
I feel like Tony took a pass on the ESG question, so I'm going to avail myself of.
Okay, I'm going to ask you a follow-up then.
Okay.
Do you think most of us in this room have a strong view and certainty on which way the election will go? Or do you think there's just...
I think that we proved that we don't last time, right? So I think consistently, whenever we all think one thing's going to happen and there's a lot of consensus around that, something else tends to happen. So
We just need to hold our breath and get through the next 4 years and wait for a new generation of leadership.
Spoken like a true credit investor. Dan, anything to add? I know we just have under 2 minutes. There is one audience question here that I did want to throw out, but we may not have time. So I will go to the predictions section. Looking out, and this can be in any category that you want, but this is just an insight to how you think. I'll start, Jose, hopefully with you. If you don't pass, then I'll go to Katie if she doesn't pass. Give us one prediction in any category that you think will come true in the next 12, 24 months.
Yeah, I think whether it's the next 24 months or the next 5 years, you will see the form of, again, guaranteed income in just about every 401k plan in America. So again, when you think about that $12 trillion piece, you're going to see more focus on that stability and guaranteed income. And that's a big deal, which is why you're seeing a lot of our peers doing what they're doing and these strategic deals being announced as well.
Dan?
I would say that after this session, we'll all part as friends, is my prediction. But no.
We already were friends.
We will continue to be friends. No, I guess my one prediction, I actually think that the U.S. economy is more robust than people think, and so I will say there won't be a recession over the next 18 months. We've been believing that probably pretty consistently for the past couple of years.
Kamal?
Since you asked for a prediction, these are tough to make. I think more money will be made in public markets in AI than private markets.
Wow.
And I think the fundamental shift that's upon us is, there's a saying that software eats the world, but hardware runs the world, and hardware is going to come back in vogue.
Katie? Your prediction?
We would predict that regardless of whether or not we have a recession, let's say we don't, and rates stay elevated, we're going to have some credit events and possibly the first distress cycle in this asset class we spoke about most of the time in this panel, which is private credit. And so we think this could be one of the best environments ever for rescue investing, even if we have a reasonable economic backdrop with rates elevated. And if we get a recession, that will even broaden that opportunity set. And I'm talking control positions in direct lending, not traded distressed credit. That's a prediction.
Tony, take us home.
I'm going to let off by saying that we don't predict where interest rates are going to be or where the stock market is. I'd just say the Rangers are going to win the Stanley Cup.
Yeah. Thank you very much. Thank you all.
Great.